Hi there. Welcome to the Open here on BNN Bloomberg. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Prime Minister Mark Carney and Alberta Premier Danielle Smith will meet today in Calgary, where they're expected to reveal a plan for Alberta to raise its emission price to $130 per tonne by 2040. This move comes after Alberta froze its industrial carbon emission price at $95 last year. This move also works to fulfill a pledge between Alberta and Ottawa that included a carbon price plan in order to build a pipeline to the West Coast. And sales in the latest quarter at Interfor missed analyst expectations as weaker lumber markets continue to pressure the forestry sector. Revenue fell 13%. The Vancouver-based lumber producer also saw a wider quarterly loss. Interfor says they expect continued volatility in North American lumber markets. And U.S. President Donald Trump says a lot of problems with China were settled and called his relationship with Chinese leader Xi Jinping a strong one. The comments come as Trump concludes his trip to China, where he had hoped to get Beijing's help to convince Iran to open the Strait of Hormuz. Although no concrete deals were etched, the two leaders walked away on stable terms. And we're watching the markets today, starting with U.S. futures. A bit of a broad sell-off happening in bond markets, which is dragging stocks lower today. The Nasdaq down almost 2% at the moment. The S&P 500 down more than a full percentage point. We're also going to be watching the TSX today to see if they can make more gains. It made a few yesterday, closing just above 34,000. Continue to watch that once markets open in about half an hour's time. And we're watching the price of oil. It is heading for a weekly gain with Iran war negotiations at an impasse, up almost 3% at the moment. Continue to watch that for you. And of course, the price of gold, as oil rises, gold tends to fall, it seems right now, given what's happening in the Middle East. And it's down this morning, down more than 3% at the moment, giving back some of the recent gains we saw over the last couple of weeks, although it has been dropping throughout this week. All eyes are on the new U.S. Fed Chair Kevin Warsh as the U.S. economy faces a delicate balance with elevated inflation and a softening job market. So how do you build a portfolio to withstand ever-changing market sentiment? Let's find out with Alex Giuliano, Chief Investment Officer at Resonate Wealth Partners. Good morning. Thanks for joining us.
Morning, Lindsay.
So Kevin Warsh now confirmed as the Fed chair. He's got a lot on his plate because we know Donald Trump has been pressuring for rate cuts for quite a while, but inflation is ticking higher. So how much room do you think Warsh actually has to maneuver here?
Yeah, Warsh is obviously dealing with a very complicated macro environment in the backdrop. And you see the move in rates this morning really just lending credence to the fact that the rate picture is becoming more uncertain. You have inflation data that had come in very noisy earlier this week, not really giving any justification of rate cuts there. You have the war in Iran the conflict in Iran continuing to play out. And so the new Fed chair is really looking to guide market expectations through this delicate balance. And if inflation continues to stay elevated, with the job market clearly softening, that's a fine needle to thread, especially with the backdrop of midterm elections coming up.
Yeah, a lot going on there that we're going to watch for. Markets have been reaching new highs. They're down today, though. You think sentiment feels anything but certain at the moment. So maybe today's proof of that. We're seeing U.S. futures down quite a bit. Why do you think that, though?
Yeah, it can obviously be difficult for investors to monitor market sentiment, especially with the moves we've had in the last few months. It's especially clear that sentiment can change in a dime with very little notice. I think one of the best ways investors can withstand the changing market sentiment is to build a stock portfolio, especially centered around quality. And in this kind of environment, quality means companies that have strong cash flows, durable profits that can withstand a lot of different economic environments. And in this environment, I'm really leaning investors toward the U.S. stock sectors, particularly in financials, healthcare, and the select big tech names that have a clearly defined AI strategy, where investors aren't necessarily chasing the story, but rather a cyclical boom.
So those are the sectors you think investors should be looking at. Or is there anything to avoid at the moment?
I think the big thing investors should avoid is companies that are riding the wave of the AI transformation, but don't have a clearly defined strategy. You've seen that a little bit with the pullback in the SaaS names in particular over the last several months. And so I think for investors, they really want to suss out what quality means in this type of environment and lean into those positions. rather than trying to just simply buy the narrative. The narrative has driven many names higher in the last few weeks. But if you're looking at taking advantage of opportunities out there, there are companies that have quality, especially like I mentioned in the financials and healthcare space, that haven't ridden that wave nearly as much. And so just seems like there's a greater opportunity in those names, especially with the run-up that we've already had.
Yeah, let's talk about that a little more, because companies are pouring hundreds of billions of dollars into AI. That's part of the reason for the run-up. Yet bubble concerns do not seem to be going away. Do you think those concerns are justified?
Yeah, there's always a narrative that there's a bubble out there that investors are trying to time, and everybody seems to want to pick what that top or bottom may be. I think it's important for investors not to necessarily try to time if this is an AI bubble or when that bubble may pop. I think at the end of the day, we're seeing a structural investment boom. And with that, I want investors to focus on investing and not necessarily speculating. Companies that have the ability to build and lead the way on the AI charge and have the financial strength to pivot if they needed to dial back investment or the investments they made haven't panned out the way they want are really where consumers and investors should look because companies can make mistakes as part of that boom, but you want the ones that aren't just running on the borrowed excitement and really have the ability to take advantage of the structural boom, even if investment slows down.
It can be hard to at this moment in time, realize which companies that is and which ones are not on that track, right?
Absolutely. And trying to parse between the narrative and what those investments look like is typically important. But I would say the companies that have those profits and different profit centers that aren't necessarily focused on AI development alone can withstand a pullback in that boom cycle when and if it does happen.
What about hedges right now? Are you looking at gold? Are you looking at bonds? Where do you think is a safe place for investors to be?
Yeah, obviously we've had a tremendous run up in the gold market and commodities have obviously run up with the conflict in Iran. I would say the opportunities for U.S. investors is to kind of spread into different baskets that they may not have ordinarily been. A lot of U.S. investors have found themselves overextended in the tech and U.S. markets, just considering the run up we've had over the last decade plus. And so I'm seeing continued opportunities in the international market, especially with debt concerns around in the U.S., the potential devaluation of the dollar over time. And so with U.S. stock markets trading where they are, the valuations internationally look like an opportunity for investors to take advantage of spreading some of their assets around.
Yeah, I wanted to ask you about that because you did say at the beginning you kind of point investors towards U.S. companies at the moment, but I did want to talk about international markets. And I guess maybe you can dive deeper into which ones you're talking about that maybe have some investment opportunities.
Yeah, I think in particular internationally, I see opportunities in Japan, India, and Europe. These are regions that have been experiencing economic growth, and the stock markets are not up nearly as much as the U.S. over the last 5 years, which creates a potentially attractive entry point for investors. I think the biggest thing investors want to focus on is trying to skate to where the puck is going. And so, when you have the opportunity with valuations already being much lower than the U.S., at the potential for currency tailwinds for those international names, there's real opportunity there for economic growth that U.S. investors may not have already been focused on over time.
What about Canada, just lastly? I know that's not an international market for you, but what are your thoughts on investing in Canadian companies right now?
Yeah, I think there's definitely an opportunity in the commodity markets, especially with the run-up in oil over time. I think there's an opportunity set that in those international markets, particularly investors haven't focused on some of the emerging markets or developed nations that haven't been top of mind. And so there's real opportunity there for investors to take a look at some of those potentially overlooked spaces that have really high quality companies, but don't necessarily have the narrative behind them. And so with those valuations being lower, like I mentioned, and the opportunity for hedges that are presenting themselves, is a real opportunity for investors to take a much closer look at that space.
Okay, we will leave it there. Alex Giuliano, Chief Investment Officer at Resonate Wealth Partners. Appreciate your time this morning. Thanks so much. Coming up, Xanadu Quantum Technologies reported its inaugural first quarter with some mixed results. We'll speak with the CEO on that right after the break. Stay with us. We are watching shares of Xanadu Quantum Technologies today after it reported a bigger than expected loss, while revenue topped estimates. The company had a whirlwind start after publicly listing on the NASDAQ and the TSX. So for more, let's bring in Christian Wiedbroek, CEO of Xanadu Quantum Technologies. It's good to have you back on the show. Thanks for joining us.
Thank you for having me. I appreciate it.
I do want to talk about your latest quarter, but first I want to talk about the kind of roller coaster that the stock price for Xanadu has been on since you listed on the TSX. It skyrocketed, and then on May 4th, it dropped more than 60%. Obviously, when it took off, that made you a billionaire within a couple of days. But that drop, I mean, what was the reaction from shareholders after that drop on May 4th?
Well, that's a good point. I would say that we've always taken a long-term view here at Xanadu, particularly with quantum computing. So we try very hard not to look at the stock price and really thinking years ahead. So anything it does in the meantime, we try to just keep focused on what we're doing here in building photonic quantum computers. I would say too, a drop is really not unexpected when you have a small float, which is a characteristic of doing a de-SPAC process. So things are going the way they should, and we're really excited about the future.
Yeah, I take your point. A drop isn't necessarily unexpected, but that was quite a drop, right? Like, did you think that was a sign that early investors were kind of heading for the exit?
No, we've got some great investors. I think the key point there is that there's little float, so you can see dramatic upswings as well as low swings, as we've seen. Really, honestly, I think the more float we have, the more stable the stock will be, and it's a characteristic of a de-SPAC as well as quantum computing as well. So we're looking forward to the next year and the years ahead.
Did you sell any of your shares during that sell-off that we saw?
No, we're actually, myself and all the employees and early investors, we have a 6-month lockup period.
Got it. Okay, so let's move on to your latest earnings results, your first one since listing on the TSX. What do you think is attributing to the kind of mixed results that you're seeing?
Honestly, it's really hard to pinpoint one particular thing. As mentioned, we think long term here, so we look to the future in terms of what could be happening today. And honestly, since we've gone public, it's really hard to pinpoint. Certain things may get the stock excited, and other things may bring it down a little bit. I do think that the small float is one of the big reasons there. But honestly, this first earnings call, we believe it went well, and really it was not that long since we've gone public. So it's more about reiterating our story, our unique photonic-based approach, first photonic company that's actually public, and also our penny lane software stack, one of the most widely used ones anywhere in the quantum world. So really it was an opportunity for us to reiterate those two things.
And I do take your point that you're looking long term, but the latest results show like very strong revenue growth, but losses are widening as well. So how should investors kind of balance out those two things?
I would say a couple of things. It's a great question. Revenue is not our main driver here over the next couple of years. We've been very clear with that with investors, and I think it's resonated with investors. What is important is our hardware milestones and our hardware roadmap, achieving what we say we're going to do from a hardware point of view. And also, it's more about partnerships than revenue. So having long-term partners that will stay with us over the next couple of years, that will ultimately be our first true customers once you have a large-scale quantum computer. We've ultimately said no to short-term revenue of selling single system quantum computers. We're focused on the large-scale quantum data set, and the intuition there is that these small systems are no more powerful than GPUs. So let's keep our eye on the prize and build a large-scale quantum computer that will hopefully change the world and bring in dramatic revenue at that point in time.
Yeah, I want to talk about the future of quantum in the market, because when you saw the spike in your shares at the end of April, early May, that was after NVIDIA echoed confidence in quantum computing. Do you think that will be a replicated phenomenon or just like a blip in the market? Like, what is the long-term outlook for quantum on the market?
Yeah, great question. I would say that we've seen these blips before, and NVIDIA has been involved in them in the past year and a half of the public companies that were already existing before we went public. I think we'll see more and more of these things over the coming years, these blips that drive the stock price up. And that's a function of people trying to really understand quantum computing. I think our investors and investors in the quantum space really know that this is a long-term play. We aim to build our quantum data center by 2029, 2030. So it's not next year, but it's not too far away. And so the real investors that understand this space understand it's not going to be something tomorrow. But every now and then you'll see some big news that, like NVIDIA announcement, that really drives the stock up. One of the things that we're very clear with our employees is we say, just get back to work, just focus on 2029, 2030, building this large-scale quantum computer. Assume there's volatility in quantum stocks, and things will eventually settle down, but have a long-term mindset.
I know, because 2029, 2030, as you say, it's not that soon, but it is not far away. That's a pretty tight timeline. Are you on track to meet that?
We are on track. What we've tried to do with our earnings call is really be as open and honest as possible. And the reason I bring that up is we're on track for 2029-30. Note that we didn't say 2029. We do give ourselves some grace there for building this large-scale quantum computer or quantum data center. And there's uncertainty there, and it's important for investors to know that. But investors like this because they know that quantum computing is one of those few technologies that will change the world. It's deep, deep tech. We really are storing, manipulating, and measuring information at the quantum level, which is very hard to do. So I think there's a grace period with quantum stocks, including Xanadu. But our strategy is be as open as possible with our timelines. And getting back to your question, we have been on track, and we hope to continue to be on track in the coming years as well.
Penny Lane is one of the most widely used quantum software platforms. It's free today, but it can lead to monetization down the road. I'm wondering if maybe you can explain to our viewers, because as you say, there's still a lot of understanding that has to go around quantum. Explain what Penny Lane is and the timeline for that monetization.
Yeah, for sure. So Penny Lane is essentially the operating system for quantum computers. It's the way you log in and program quantum computers. And it's ultimately the way that customers will log in and use our quantum data center in 2029, 2030. So, for your viewers, think of any hardware we have, whether it's our computers or phones. You need software to interact with them. And the same is true for quantum computers. So that's what Penny Lane is. As you mentioned, it's one of the most widely used software offerings anywhere in the world. It's also agnostic, so meaning that customers can use our hardware, our photonic hardware, if they want, or if you're, attuned to some other hardware, Penny Lane will also operate on that as well. So it's been very successful. It's in over 150 universities around the world in over 30 countries, and people have a true love for Penny Lane. And so we are thinking, we haven't announced anything yet, but with any open source model, not even quantum, but go back, for decades now, there is the ability to monetize open source software, well-worn path through services or tiered offerings for enterprise offerings and so forth. So we are considering all options at the moment, so stay tuned on that.
You've also announced negotiations with the Government of Canada and Ontario for Project Optimism. I'm not sure how much you can say about this project at the moment, but maybe just kind of explain what that is and rough timelines for that.
Yeah, for sure. So it's still in negotiations with both the federal and provincial governments. It's up to $390 million Canadian. And the exact mechanisms, financial mechanisms, and what it's used for is really TBD. We'll have an announcement hopefully soon on that. What I can say, it fits in nicely with our roadmap and ultimately our goal of building a large-scale quantum computer, a quantum data center.
Just lastly, you mentioned previously that quantum computing can revolutionize drug discovery and pharmaceutical development. Are there any partnerships in pharmaceutical companies that you're looking at moving forward?
We can't announce them that yet, but stay tuned. I can say at a high level, though, that quantum is going to be very significant and change the world in many industries. Drug discovery, as you mentioned, is one. We've announced partnerships in material design and quantum chemistry in the past. Volkswagen, Toyota, and others. Rolls-Royce, great partners for us. And also AI and finance are other big areas as well. So stay tuned over the coming months and quarters for more partnerships from us.
Okay, we'll leave it there for now. Christian Wiebrook, CEO of Xanadu Quantum Technologies. Thanks for joining us this morning.
Thank you for having me.
Coming up, the Trump-Xi summit comes to a close, but were there any real breakthroughs or just more uncertainty for investors? More on that next. U.S. President Donald Trump is heading home after a two-day summit with China's Xi Jinping in Beijing. For more, we are taking you now to Beijing. That's where we are joined by Bloomberg's Anne-Marie Horton, who has been covering this summit and all these meetings, and she joins us again this morning. Great to have you once again. So I guess now that things have wrapped up, where exactly does the relationship stand between Donald Trump and Xi Jinping?
Well, that's a great question. I think the biggest win is actually that these individuals met. There was lots of pageantry, a ton of smiles here, lots of questions, though, regarding the substance. The president is touting a ton of deals that were made, whether it was Boeing jets or soybeans that was on display here. But we still have to get confirmation from the Chinese side. And I think what remains at risk is the thorniest issue, and that's, of course, Taiwan. I still go back to what happened yesterday, which was while these two leaders were still in a bilateral meeting, the Chinese pushed out a readout saying that if Taiwan is mishandled, that would create a dangerous conflict between Washington and Beijing. The president, of course, was pressed about Taiwan on his way back to Washington by reporters on Air Force One. And he said that when it comes to the defense of Taiwan, there's only one person that knows about that, and that's him. And he said he was asked this question today by Xi Jinping himself. Of course, all of this comes in the context of the fact that we are still waiting for this administration to green light a $14 billion arms sales to Taiwan. The president said he's going to make that decision in the next few days.
Yeah, and at this point, I mean, maybe the president of the United States was hoping for more progress on the Strait of Hormuz as well, on the flip side of Taiwan. So did anything happen there? Was there really any progress made on that front?
Well, I think it remains to be seen. We'll have to see how China actually talks about Iran in the next few weeks, and what do they do? Do they actually stop supplying dual-use components when it comes to weapons? Do they actually tell their firms to abide by U.S. sanctions when it comes to buying Iranian crude? And do they put pressure on the regime to actually open up the strait? Now, the White House readout put a lot of emphasis on Iran yesterday. What we heard from the Chinese Foreign Ministry today is similar to what we've been hearing from the Chinese Foreign Ministry for weeks, that they agree that the Strait of Hormuz should be open and that they want to see dialogue continue to bring an end to this conflict. So really, the tell for all this is going to be how these two nations talk about these issues and really what they do the next few weeks to understand where the progress was made at this summit in Beijing.
You mentioned off the top soybeans, so I did want to ask about the progress on trade, particularly in the agricultural sector. What was that progress?
Well, I spoke to Trade Ambassador Jamieson Greer this morning before he left, departed for Beijing for Washington. And he said over the next 3 years, you are going to see billions of dollars when it comes to agricultural goods that the Chinese are going to be buying. And we did see maybe an emotion of goodwill yesterday. The Chinese renewed licenses to import beef into the country. And he said this goes beyond soybeans. This is the entire agricultural space. Once again, I would go back to, while, yes, this is an improvement of the trade relationship, it almost feels like we're going back to where things stood between Washington and Beijing before we had the IEEPA tariffs, the fentanyl tariffs, and the tit-for-tat trade war we saw play out last week when it comes to tariffs, and also then Beijing, of course, using their chokehold of rare earth minerals. With Ambassador Greer said today that he thinks that he gives them a passing grade when it comes to export licenses for rare earths.
Okay, Bloomberg's Anne-Marie Horton, appreciate that. Thanks so much. And stay with us. The opening bells are next. Here are the opening bells at the NASDAQ. Strive is ringing the opening bell this morning. On the New York Stock Exchange, Horizon Investments is ringing the opening bell. And on the TSX, Bunker Hill Mining is celebrating the company's graduation to the TSX. It's time now for the first 15. You're watching BNN Bloomberg. Trading is just getting underway today. We will check in on the equity markets to see where things stand. The TSX starting the day down by more than a full percentage point. Same with the S&P and the NASDAQ. It's a bit of a rough day on the markets to start this Friday. The NASDAQ down more than a full percentage point as well at the moment. There's been a bit of a sell-off in bonds, which seems to be affecting the stock market, dragging it down. So we'll continue to watch that. And as always, we are watching a couple of Canadian companies on the TSX to see what's happening there. Transat is one that we're watching. This company has said it incurred about $70 million Canadian in additional fuel costs in March and April, obviously due to the prolonged closure of the Strait of Hormuz. And the company also noted that cost pressure could persist if this war is not resolved. So you can see Transat down by 0.7% to start the morning after issuing this news. We're also watching Xanadu. We were talking with the CEO just a couple minutes ago, actually. Xanadu missed revenue, but topped estimates in its latest quarter. That was the first since listing with the TSX. It's had a really volatile ride since listing with the TSX. You can see the chart here, a steep drop at the beginning of May, dropping more than 60%. And today, after reporting its latest earnings, it is down more than 8%. The CEO saying they're not too worried, though. They're more so focused on long-term growth. And for movers south of the border, we are now joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities Team. Good morning, Jeff. Great to have you. So we're going to start talking about Ford Motors and Ford Energy. This is expected to have $1 billion to $5 billion value. That's according to RBC. Tell us exactly what is Ford Energy.
Yeah, Ford Energy is this initiative that Ford announced earlier this week, which is going to repurpose some of the battery manufacturing that they had been embarking on, but for which they took a giant write-down, and so they are kind of looking to repurpose that. When that announcement came out earlier this week, it sent the shares immediately higher, and the stock has actually gained 21% in the last 2 days. So what we're looking for today is whether or not it will potentially give back any of those gains. That 21% gain on over the course of Wednesday's trading session and Thursday's trading session added $9 billion in market capitalization for Ford. So now we have RBC out today with a note saying that they value that kind of Ford Energy business at $1 billion to $5 billion. Now that is well short of the $9 billion in market capitalization that the company did gain as a result of that announcement. Have been kind of looking for whether or not there would be a pullback at some point. Today is a pretty ugly open, as you mentioned, for the S&P 500 and for most of the companies in it. If I'm looking at Ford right now, I'm seeing it's down about 4%. So it's giving back about $2.3 billion worth of that market cap that it's gained over the last few days. One thing to note from the RBC note, and in fact, Ford mentioned this itself, but RBC is saying it's hard to value how much this Ford Energy business is going to be worth because a few things. One, it has yet to develop a product. Two, it has yet to disclose pricing. And three, it has yet to actually develop an order book. So perhaps for RBC is saying here that, maybe investors have gotten a little bit ahead of themselves. It's valuing that business at $1 to $5 billion right now, well ahead of the amount of additional market capitalization investors gave the company in the last 2 days.
No kidding. Okay, we'll keep watching that one. You're also watching Dexcom this morning. Shares are rising on growth outlook from this company. It seemed to impress analysts quite a bit.
Yeah, that's right. So Dexcom had a investor day, and they gave a kind of a long-term growth outlook. They expect to grow sales at 10% per year for the next several years going out to 2030. And that did impress analysts. There was an additional bit of news that came out that also is kind of helping lift the shares. This is the top performing stock in the S&P 500. So far this morning, it's gaining about 4%. Elliott Investment Management, which is a big activist investor, has apparently taken a stake in this company. They disclosed that at the same time as they reached an agreement to replace 2 board directors on the company's board. So, yeah, shares are moving higher for a handful of reasons. This is a company, they make devices for diabetes. And they saw their kind of valuation peak a few years ago at about $63 billion. It has come down from that quite substantially, and that is what attracted the activist investor here. So Elliott has apparently been in talks with Dexcom for a few months now, culminating in an agreement which was reached yesterday afternoon and disclosed and sent the stock higher in the post-market session, and certainly so far today looks like they are up about 5% now. So top performing stock in the S&P 500 so far today.
Okay, keep watching that one too. That's Bloomberg's Jeff Morgan joining us this morning. Jeff, thanks so much.
Thank you.
Volatility in lumber pricing is weighing on Canadian lumber company Interfor's first quarter. We'll break that down for you right after this. Stay with us. BC-based lumber producer Interfor has reported a first quarter earnings miss. The company supplies wood products across North America and Asia, serving residential, commercial, and industrial markets. For more on the results, we're joined now by Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth. Good morning. Great to have you join us.
Good morning.
How sizable do you think this first quarter miss was for Interfor?
Well, it was certainly a meaningful miss. I think this is one of those names that certainly are looking at as the poster child of being a victim of some of the trade dynamic between the U.S. and Canada. The analyst consensus running earnings per share was about 60, or a net loss of 63 cents a share. So 96 cents, almost $1 on losing earnings per share was certainly a meaningful miss. EBITDA was down. They did see some encouraging signs with lumber prices generally. But again, really, it's the Trump tariffs and the USMCA overhang on their bottom line, which has kept investors away.
Yeah, let's talk about some of those headwinds in more detail, because obviously the trade war, a big one just for the lumber sector overall in Canada.
Certainly. I mean, it's one of the most contentious issues between Canada and the U.S. with the USMCA negotiations. And I think many investors are sitting on the sidelines just out of fear that there might be some concession from the Canadian government around lumber. It's obviously been a hot button issue for Canada and the U.S. for not just recently, but for a number of years, decades even. And it's not something that's a lot of investors have major confidence in. In just Ontario, they shuttered 3 sawmills just in recent months. That's Interfor.
Are there any encouraging signs for Interfor for the next quarter?
Lumber prices moving higher has certainly been a positive. It's really a name, though, that I'm staying away from. I think there's better opportunities in the Canadian marketplace today.
Okay, that's what I was going to ask you is, would you be a buy on this company? It sounds like that's a no.
No.
Yeah. Another Canadian company reporting earnings today is KP Tissue. For those who are maybe not familiar, can you tell us what KP Tissue actually does?
Yeah, KP Tissue, they reported earnings yesterday. They are an equity stake in Kruger Products. People probably know the brand names: Sponge, Scotties, Purex, Cashmere. So they're pretty well known. They've been around since 1904, and KPT is about a 12-13% equity stake in the parent company of Kruger. Now, we actually own this company. They're sort of the other end of the wood-based products, I guess you could say. We've been buying them since the fall, incrementally been moving our position higher with them. They've cited strong profitability, 29% year-over-year increase in earnings per share, despite missing slightly on revenue. The revenue miss yesterday that was reported was largely due to currency, and really what was a stellar 2025 first quarter last year, which made for a more difficult comparison rather than a demand issue itself.
What went well for this company? You kind of touched on it, but in more detail, what went well for this company in the latest quarter?
They've been sizing up their U.S. operations in order to service that demand, which has been a key driver for them. So they've expanded operations in Memphis and another plant as well. Their plans are to add about 75,000 tons of tissue product to the U.S. market by 2028, 2029. And they're a good example today. I think there's a lot of attention, obviously, that's paid to the AI theme and the increasing valuations in that respect. KP Tissue still valued in about 14 times earnings presently, and you're getting over a 7% yield. So that's something that's been very attractive to us, and I think a lot of other investors as the stock price moved higher.
Okay, so there's some other Canadian names that you like, and we'll go down the list and talk about each of them. Maple Leaf Foods is the first one. What is it that you like about this company right now?
Maple Leaf Foods is another that we've owned for some time, and it's rewarded investors the last several years. They reported their best margins in over 2 years with their May 7th Q1 earnings report. Earnings estimates have just continued to tick higher, and they're trading at only about 6 times earnings. They split off Canada Packers, which was their pork division in 2025, and that's been accretive to their bottom line as they've really beefed up their operational efficiencies for the company, and they've been a great hold for us.
What about Rogers Sugar? What opportunities are you seeing there?
Rogers Sugar, so well-known Canadian company, kind of coast to coast in sugars and maple products, still trading pretty reasonably at about 12 times earnings. Again, earning estimates moving higher, and you're still getting a pretty reasonable yield with the shares today, even despite the run-up over the last 12 months.
OpenText, that's another one that you like right now. Why is that?
OpenText is a Canadian example of a victim of that software sell-off that's kind of grappled a lot of attention with investors in the first quarter. They actually beat expectations on their May 7th Q1 reporting. Their earnings per share beat by about 10 cents, estimate or 11%, and net profit actually jumped 86% year over year. So really, in contrary to some of what we're seeing in the headlines around the death of software and the software apocalypse. And I think that they're a Canadian name that's trading pretty reasonably, and you can't get a 4 or 5% yield in a lot of software names like you can with OpenText today.
Yeah, because there is a lot of chatter about how some software companies will make it, some might become redundant, and this this sounds like this is one that could maybe make it, you're thinking?
Well, I think that for some of these names, you just have to go from bad to less bad in order to see some momentum in terms of the stock price. And I think that the death of software is overstated. I think even the AI companies have acknowledged that software has a role in the years ahead in this as AI is integrated into these platforms. And I think that the well-run companies, the managers that are making intelligent decisions and have been through the ringer over the last several decades are the ones that are best positioned to adapt to those changes.
Speaking of narratives, just before we wrap up here, earnings season overall, wrapping up, what do you think are the emerging narratives that came out of the latest quarter?
Well, obviously AI was the clear winner. I think that analysts generally missed on the low end. I can't get over how similar it feels to last year, where Q1, Q2, everybody brought down earnings estimates just because of tariffs. And then this year, it feels like the analysts were too conservative with some of what they were seeing in regards to stocks that they were covering, especially on the AI side. Industrials, energy, obviously on another one, which had been in the news. And thematically, we really haven't changed much in April and May. I would say that we've been more of a net seller than buyer, as we've taken some of the winners and trimmed back and built up cash within our strategies. I don't think that I'm in the sell in May and go away camp, but I think as earnings headlines roll off, that it'll put more pressure on sort of the news items of the day. And I don't think we'll see any shortage of headlines as the trade negotiations get started over the summer. The months leading up to a U.S. midterm election tend to be softer from a market perspective. And I think if you put the first 4.5 months into perspective, that's a pretty great return. There was a time where that was considered a pretty great annual return, but obviously it hasn't been the full year yet. And we might see some sort of summer pause, whether that's the beginning of it today as people sort of grapple with the increasing prices on the AI trade. But I think that there's still opportunities there, and we would like volatility to pick up, as we have several names that we'd prefer to pick up at cheaper prices than they are today.
Okay, we will leave it there. Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth. Thanks so much for coming on. Appreciate it.
Thank you.
Yesterday on Market Call, we were joined by Stan Wong. He is portfolio manager at Scotia Wealth Management, and he was covering North American large caps and ETFs. These were his top picks: NVIDIA, Dervanova, and Invesco DB Base Metals Fund. Today on the show, we've got Eric Nuttall. He is partner and senior portfolio manager at 9 Point Partners, and he'll be taking your questions on energy stocks. So be sure to tune in today, 12 p.m. Eastern Time. Just ahead, we'll take a look at some of today's notable calls, including a downgrade for Boralex. More on that after the break. Stay with us. A long-awaited national electricity strategy was announced yesterday by the Prime Minister. It is a significant plan to double the grid by 2050 and in the process transition to a low-emission economy, create jobs, and bring consumer costs down. CTV's Abigail Beeman breaks down the proposal and whether it can be accomplished.
The Prime Minister amped up to deliver a long-awaited electricity strategy with a plan to double Canada's capacity.
As our industries expand, our economy grows, AI accelerates, electricity demand in Canada is expected to double by 2050. So we will double our grid.
The government estimates the expansion could add 130,000 high-paying jobs by 2050.
This announcement in electricity, as far as I'm concerned, is the greatest announcement since, well, electricity itself.
Canada's current electrical system is complex and siloed. The Prime Minister concedes it's often easier to trade power with the United States than interprovincially, costing Canada billions.
Tying our grids together, that will be essential, and that's where the federal government has to come in and help the provinces make good choices that work strategically for the nation.
80% of our electricity from non-emitting sources. Most of that's hydroelectricity, some nuclear, and then there is some natural gas that is regionally very important.
Especially important in Western Canada. So to help build and power an expanded grid, Mark Carney is proposing to loosen Trudeau-era regulations to allow a scale-up of natural gas.
It is a betrayal of the years of time that was spent with stakeholders and utilities and Indigenous nations on developing the federal clean electricity regulations.
He re-announced the same electricity plan that the Liberals have used over the last decade to jack up the cost of power bills by 35%.
While the government promises this will eventually lower bills, it pegs the overall price tag of an expansion at more than $1 trillion and couldn't provide any details about a breakdown or who will pay for what.
That was CTV's Abigail Beenan. Okay, we're going to go to notable calls now. And our first notable call is from Boralex. Raymond James is downgrading Boralex to market perform from outperform with a price target of $37.25. That's down from $38. The company is moving toward closing its take-private transaction with Brookfield Renewables, and the analyst tells investors that in a research note. Our second notable call is for Power Corp. TD Securities downgraded Power Corporation to hold from a buy with a price target of $84 Canadian. That's up from $74. The analyst says earnings growth from core operating companies is, quote, evident, and capital returns are, quote, healthy, but these positives appear priced in, and the total return potential based on the firm's raised target suggests a hold rating at this time. Our third notable call is CIBC initiating coverage on MDA Space with an outperform rating and $57 price target. CIBC says its investment thesis rests on three core pillars, which are the company's unique exposure to multiple secular tailwinds driving the space boom, its status as a scaled, well-capitalized, and profitable pure play amid an industry of mostly unprofitable peers, and a valuation that is undemanding relative to both A&D peers and space sector peers. Stay with us. When we come back, we are talking investing strategies with the barbell approach in focus today. That's next. With stocks at all-time highs, we've been hearing from both bulls and bears. But for investors, it can help to build a portfolio that performs regardless of market conditions. That led one money manager to create what he calls a barbell portfolio. BNN Bloomberg contributor John Ehrlichman has a new story about that on our website, and he joins us now. And John hosts the investing channel Ticker Take on YouTube. So John, good morning. Let's get a financial workout here and walk through the specifics of a barbell approach to investing.
Absolutely, Lindsay. And I think it's a good week for it as well, to your point, because we've been at these all-time highs, and that brings out strong punditry commentary from bulls and bears. You have, Michael Berry, who's giving a very skies falling warning to people. And then on the other hand, you've got strategists like Ed Yardeni, who is leaning into the tech boom and the earnings growth and says, relax, folks. But I think the lesson is that the market can go any way. And that's why in the latest Ticker Take, Jay Hatfield, who, to your point, takes this barbell approach, he's looking for stuff that might have a little less torque and stuff that actually can ride the wave of more growth. And that's how he balances it out, high beta and low beta, which sometimes sounds complicated, but it's really companies that have a little bit more momentum when the stock market is doing well. And if you're concerned about things getting choppy out there, lower beta stocks tend to be more predictable. They don't move as much. There's a certain reliability, and the benefit from doing all of that is creating a portfolio that sort of weighs itself out and maybe allows you to focus less on whether we're going to be higher this week because of AI or lower next week because of war worries, all that kind of stuff.
Okay, so you have highlighted 8 stocks in your story on the website. We're going to go through a couple of them here. We'll start with Amazon as one of those examples.
Yeah, Amazon would be a higher beta stock, not the highest beta stock out there. I mean, there are certainly some of the AI chip plays that have much higher betas right now. But, Amazon, which at last I checked is kind of getting close to a $3 trillion valuation, has a lot of things to like if you're looking for more momentum, right? I mean, they're literally building their own AI chip business, but they've got AWS. They are riding the growth story, but they also have a certain amount of predictability. So they have a higher beta than the average company out there. And by the way, it is a stock that is recommended by the majority of Wall Street these days. Now, on the other side, Jay talked about a number of low beta companies, particularly in the energy area. One name, Lindsay, that he talked about is Energy Transfer. So this is a company that feeds into a number of parts of the U.S. energy economy, including storage, but it's not going to have the same kind of move as what you might see from an AI darling. Instead, what you're going to get is a certain amount of predictability in how their business is run, the cash that's coming into the business, what kind of sort of dividend opportunities ultimately will be there for investors. And so lower beta, less moves up and down, but some predictability there. Whereas Amazon, you're going for a little bit more torque in the portfolio, but you're going to be ready for a possible slap in the face if things start to get a little bit scary out there.
Okay, we will leave it there with those couple of examples. John, thanks for that. And you can find John's story about 8 stocks for a barbell portfolio on our website, as well as the Ticker Take YouTube channel and podcast. A new U.S. Fed chair, earnings beats, and global headlines are moving the markets every day. So where are the opportunities and what are the risks? More on that after the break. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. Prime Minister Mark Carney and Alberta Premier Danielle Smith will meet today in Calgary, where they're expected to reveal a plan for Alberta to raise its emission price to $130 per ton by 2040. This move comes after Alberta froze its industrial carbon emission price at $95 last year. This move also works to fulfill a pledge between Alberta and Ottawa in November that included a carbon price plan in order to build a pipeline to the West Coast. U.S. President Donald Trump says a lot of problems with China were settled and called his relationship with Chinese leader Xi Jinping a strong one. The comments come as Trump concludes his trip to China, where he had hoped to get Beijing's help to convince Iran to open the Strait of Hormuz. Although no concrete deals were etched on either side, the two leaders walked away on stable terms. And shares of Interfor are taking a hit today. That's after sales in the latest quarter fell short of expectations, with revenue falling 13%. Weaker lumber markets are continuing to pressure the forestry sector. The Vancouver-based lumber producer says they expect continued volatility in North American lumber markets as the economy continues to adjust to shifting policies, tariffs, and geopolitical uncertainty. And we're watching the TSX today, starting the day down by more than a full percentage point, now below 34,000 points. We'll continue to watch that. That seems to be the trend across the markets today, including U.S. markets. We're also watching those closely. It's a bit of a sell-off happening this morning. The S&P 500 down more than a full percentage point. The NASDAQ down at this point almost 2%. It is a pivotal day as Jerome Powell's era at the U.S. Fed officially ends and Kevin Warsh takes the reins. Markets are watching his every move amid Trump's demands to cut rates. Add to that Trump's China visit and Middle East conflict. There's plenty to unpack here. So let's get into it with Laura Wellen, Managing Director at UBS Wealth Management. Good morning. It's great to have you join us.
Good morning.
A lot to unpack here. Let's start with Kevin Warsh's first kind of official day as the U.S. Fed. What's the move you expect, and what should investors be watching for closely when it comes to Kevin Warsh?
I think the beginning, he's going to want to build his credibility. So I don't think he's going to do anything cutting rates anytime soon. I think with the PPI data that came out this week, much higher than expected. I think people are watching, including the market, what he's going to do. Thinking this pushes the rate cut. Potentially one in December, another one first quarter 2027. I do think it's interesting that Jerome Powell is staying on. So I think that'll be interesting to see unfold today.
When you say that Kevin Warsh will spend a bit of time building his credibility, does that mean like not giving in to pressure from politics?
Yes, I think Trump is definitely pressuring for rate cuts, which we've seen with Jerome Powell's tenure. And I definitely think Kevin will have at least 1 to 2 meetings where he's evaluating everything. He's kind of talked about what he wants to put emphasis on, but I think everyone's watching and he's going to wait to do anything, I think definitely for the first couple meetings.
Where do you think that leaves the markets? Because obviously we're seeing quite a downturn this morning. I'm not sure how much that has to do with Kevin Warsh kind of taking the reins, but where do you see the markets going forward?
I think the markets are taking some profits today. You know, we were leading into 7 weeks of market uptick. when you look at earnings, I think the market still has room to go. I think 84% of companies have reported above earnings, and they've been double digit above what the estimate would be. There's still lots of cash on the sideline. People are starting to want to deploy some of that, but I think we've still got room to run here.
Yeah, an earnings beat kind of across the board in this latest quarter. Looking forward, though, I mean, do you expect that to continue, especially when you start to price in, when all these companies start to see the effects of what's been happening in the Middle East over the last couple of months?
I do. We've already experienced one cut in the market, so down 10 to 15%. When the war happened, on average, you get 2 cuts or 2 downturns per year. So I think if we get some kind of movement in the Middle East, you'll actually see a pop in the market. I think the market will be relieved. I don't know how long this drags on, but I definitely think that the companies with the cash on the sideline, I think the investment in AI with companies across the board, you're starting to see some more efficient technology within the companies. I think we'll see good earnings for the rest of the year.
Okay. With everything happening right now geopolitically, the kind of economic policies around the world, where do you think is a safe place for investors to be right now? Like, what are some of the sectors that you like at the moment?
I really love high quality dividend paying companies. They typically do well in late business cycle, but also in recession. So for us, that's really important. I think there's opportunity both developed and emerging market international. So when you looked at the correction that we had in the market, international companies were down double digits. They've been kind of discounted over the last decade, and there's some really strong companies overseas. And so we believe in that. I think another thing short term, call it 6 to 12 months, owning commodities that are actively managed. I think they're a good hedge to geopolitical and what's going on overseas. Clients should benefit from that.
Are there certain commodities you like more than others?
We like the metals. We've owned metals for a while. They did very, very well in 2025. We continue to hold the metals. I think rebalancing here makes sense. I think taking some risk off the table with markets being so high, if there's a need for cash over the next 2 years, but I think that that's a good hedge, 6 to 12 months.
And what about sectors that maybe it would be a good idea for investors to avoid right now? Like, what are you not feeling as confident about?
You know, I feel that tech has run here. I think you need to own tech, but I think trimming some tech, we've had a big run in the Mag 7, potentially cutting back some of that and not having so much exposure to tech.
Interesting. Okay, so I want to also talk to you about Donald Trump concluding his trip to China in Beijing. What do you think the expectations of that trip were, or what were your expectations, and what do you feel has actually been achieved after that meeting?
I thought it was very interesting that he took businessmen and women with him. I think that was, a move where all of those people had some kind of tie to China within their business. I think getting the chips to be able to ship to the 10 Chinese companies was a big win. I think for those business people to be able to share their relationship with China, why it's important to have that relationship with China. So overall, I actually think the meeting went well. And things came across that the number one thing being that they do want the Strait of Hormuz to be open. That's important globally, U.S. So I think overall the meeting went well.
Very important. Are you a little cautious by the lack of some of the details, though? Because we know Donald Trump has said Friday that China would be buying, quote, billions of dollars of soybeans in the future, but there's no details on any new purchases. Like, does that sit well with you? Or are you feeling a little cautious about that?
Yeah, I think it was interesting that there's data all over the news this morning about the meeting, but not much data of actually what happened. So I think they all agreed that there was a lot of things that were covered in the meeting, but not really ready to leak it to the media yet. So a little bit concerned of whenever there's a meeting, it's always great, but then we don't get a lot of detail.
Okay, we'll leave it there. Laura Wellen, Managing Director, UBS Wealth Management. Appreciate your time. Thank you.
Thanks so much.
Coming up, we will keep the focus on China. When we come back, we're going to take a look at how China was able to capture the rare earth market. More on that after the break. Rare earths are the backbone of modern tech, and China has cornered the global market for them. As it uses that dominance as geopolitical leverage, can other countries break its grip? This weekly doc from Bloomberg dives deeper.
It doesn't look like much, But this is the prize for the rest of the world in trying to catch up with China.
We need rare earths.
China owns them, processes them, refines them, and sells them. The entire supply chain is built around Beijing.
No matter what you do, you're always kind of beholden to China.
Rare earths are really the backbone of modern technology.
China's the ballgame. They're 80 to 90% of production and processing of rare earths that go into all equipment around the world.
And China's shown it will use that dominance as geopolitical leverage.
The main use of rare earths are in these powerful, high-performance magnets.
China's capacity for magnets is vast compared to the rest of the world.
When Donald Trump returned to the White House in 2025 and rebooted the US-China trade war, China responded with export controls on rare earths that exposed just how much Western manufacturing still depends on China's supply.
The automotive industry came out and not so quietly said, we are going to have to shut down factories if we cannot get these permanent magnets.
That shock set off a broader scramble to build a new supply chain from mine to magnet.
This is a story about not letting one country hold all the chips on what is a very important supply chain.
The US-China trade war has begun.
In case you'd forgotten how influential rare earths are, it was little more than a year ago that they forced a pause in the US-China trade war.
We have a 145% tariff on Chinese goods. Neither one wants to be the one to pick up the phone first.
In April 2025, US President Donald Trump slapped huge tariffs on Chinese imports. Beijing fought back, pulling out its rare earth bazooka.
The automotive CEOs from Detroit were all showing up telling Donald Trump, if you do not get those permanent magnets, which are made from the rare earths, moving back into the United States, we're going to have to start shutting factories.
Beijing had located the weak spot, and at the center of it was a group of metals most people never think about.
Rare earths are a group of 17 metallic elements that are chemically very similar.
They can seem obscure, but the important thing is what they do. They help create powerful, heat-resistant magnets.
They're used in, most of our modern technologies, especially in electric motors. They make our gadgets smaller, lighter, and more powerful.
From phones and wind turbines to electric vehicles and missile systems, rare earth magnets sit inside much of modern technology. And that means the global high-tech economy relies on one country.
China is home to the world's largest rare earth deposit that's been discovered so far. And specifically, it has deposits of heavy rare earths, whereas the US has very, very little.
Heavy rare earths are the most expensive and sought after. They allow high-performance magnets to resist heat and demagnetization.
The real choke point is the processing stage. China controls 90% of the refining process. And then it goes to magnet production, which is the process of making rare earth metals into magnets. And China controls about 90% of that as well.
Mining the ore is only the start. The real work is in the chemistry, separating and refining each element into something magnet makers can use.
The production is so costly and also environmentally very damaging because the processing stage, produces a lot of toxic waste, including radioactive materials. So a lot of Western countries, they're happy to let China take over.
And you can see why. This is Baotou in Inner Mongolia, home to China's largest rare earth production site.
Wherever you are in the world, at some level of that supply chain, you are probably reliant on Chinese products.
With China holding such a dominant position, why did it come as such a shock to the Trump administration when they chose to use it?
Really shouldn't have been, because China used the exact leverage 15 years ago.
Perhaps because last time it wasn't the US in the crosshairs, it was Japan.
China first used its dominance over rare earths as a geopolitical weapon in 2010 when it restricted exports to Japan because of a territorial dispute.
China said, okay, we are going to restrict the exports of our rare earths that you need, Japan, to turn into the permanent magnets that go into your automotive industry and other industries. This was the first kind of shock to the market.
It lasted only weeks. Even so, it exposed Japan's vulnerability and offered an early warning of how much leverage China had built. To understand how that happened, we have to rewind.
Actually, the US was the biggest player in rare earth all the way from the 1950s to the 1980s. China is a latecomer in the industry, but it caught up really fast.
This was not an accident. Beijing treated rare earths as a strategic industry and built capacity all the way down the chain.
China's late paramount leader Deng Xiaoping has said famously that the Middle East has its oil, but China has its rare earths.
As China scaled up, it became cheaper to buy from there than to make it anywhere else. In the West, thin margins, high labor costs, and dirty processing pushed many operators out.
Consumers were happy with the status quo because they got a steady flow of cheap, reliable supplies of magnets from China for many, many years.
But now the risks of relying so much on China are clear, forcing countries to make their own rare earth plays. This is the largest rare earth processing site outside of China. It's run by the Australian mining company Lynas, which has a $96 million contract to supply heavy rare earths to the US Department of Defense.
Lynas is really the leader in the wave of companies now trying to rebuild the rare earth supply chain outside of China. They started more than a decade ago, took them a long time to start ramping up production.
Lynas aims to produce over 10,000 tons of rare earths oxides per year from this site. But most importantly, it's worked out how to produce heavy rare earths.
We broke the monopoly on separated heavy rare earths last year in May 2025. We are the only producer at scale of both separated lights and separated heavies outside of China.
Rebuilding a supply chain this specialized also means rebuilding skills, experience, and industrial muscle.
Last year in the US, they graduated 35,000 lawyers. They graduated 350 mining engineers.
Meanwhile, China has a dedicated mining and engineering university with 25,000 undergraduate students.
China has invested in developing competence in the rare earths market and getting better and being more efficient every day.
And the urgency for the US has only grown as its war with Iran has depleted the Pentagon's advanced weapon stocks.
We've seen the US burning through its stockpiles of defense systems and weapon systems really quickly. And the US will need to replenish these stockpiles. And to make weapons and defense systems, it requires rare earth.
The US military's exact demand is classified. But a recent report by the Center for Strategic and International Studies estimates during the Iran war, the US has used more than half of its pre-war inventory of some very expensive munitions.
There is definitely a sense of urgency, and it's not just the United States. It is the Western world.
If countries want an alternative to China, they need more than new factories. They also need new deposits. And Brazil is one of the main bets. Latin America's biggest economy is home to roughly a quarter of the world's rare earths, according to the US Geological Survey. This site in southeastern Brazil is run by another Australian developer, Meteoric Resources, that's also receiving backing from the US. The company says there are 1.5 billion tons of rare earth clay in these hills.
Our main objective right now is to put the project in production, to be the next to the world, to produce the mixed rare earth carbonates, and to develop the technology to do the separation. And we can do that differently as China does right now. If you want to be sustainable, you have to buy from a sustainable market.
And the US is also investing at home. Their biggest hope is the Pentagon-backed MP Materials. The Department of Defense bought a $400 million stake in the company in 2025. it expects to be able to separate heavy rare earths later this year. But the problem for every would-be challenger, China's big enough to squeeze margins long before new competitors are secure.
The Western world are intervening and saying that they're willing to put up money to build out these companies, to effectively be a partner that says, we're going to backstop any chance that China takes to flush you out of the market.
China's restrictions on rare earth exports to the US have been relaxing, but its ban on exports for use in US weapons is a red line.
目的是防止稀土非法外流，非法流向大规模杀伤性武器等不当用途。
I think the main lesson we can draw is that building up the supply chain takes time and a lot of efforts. Japan's dependence on China only reduced from 90% in 2010 to about 60 to 70% now. So you can tell that the 15-year process is long and it's slow.
If you're a company that wants 60% from China or 40% from the rest of the world, or 50-50, that's a more realizable goal up to 2030 and into the early next decade.
A Bloomberg intelligence report estimates $10 billion of public funds will be invested in rare earth ventures outside of China in 2026. That's a big turnaround.
The monopoly is not going to be broken within the next 5 years. But the US, Australia, Brazil, Japan, South Korea, France will all begin producing some commercial scale of permanent magnets of rare earths. And if you're sitting here 5 years from now and those nations are all producing stuff that actually goes out the door to major buyers, then that's a win.
Up next, what is Canada's steel industry looking to see in upcoming CUSMA talks? When we come back, we'll bring you a discussion with Catherine Cobden, President and CEO of the Canadian Steel Producers Association. Canadian steel has faced significant challenges due to U.S. tariffs over the past year, prompting the federal government to introduce billions of dollars worth of financial support for the industry. For more, we sat down earlier with Catherine Cobden, President and CEO of the Canadian Steel Producers Association.
We're going on to 15 months of the tariff war between Canada and the United States, unjustified tariffs on the Canadian shipments into the United States, which has seen our shipment levels drop by 60%. So very consequential impact. And for many months, the Canadian government has been helping us. There's been new measures adopted at the border on, certain trade tools, et cetera, as well as financial supports, as you mentioned. What our strategy has been from the get-go has been to align with the United States. And so there still are these areas where we need to seek, more explicit alignment. And I think they're going to be necessary for that return of market access.
I want to ask you about USMCA, or CUSMA as it's known here. In your notes, you mentioned many U.S., Canadian, and Mexican groups view this as the most effective way to compete and surpass China in the steel sector. Has this cooperation yielded any results yet, do you think?
Yeah, so, I think there's a uniqueness to the steel sector that doesn't reside in many other sectors, and that's that we are combating on a daily basis overcapacity in steel globally. And so that comes into the shores of North America and really distorts our market, impacts our prices, and has an effect. So up until 2025, when the tariffs came on us from the United States, we were really working in lockstep with the United States to basically bring, kind of a united front against that global overcapacity. Under the trade war concept, that's been harder and harder to do because, of course, we're not in alignment anymore as we have been, targeted by the United States tariffs. So our hope is that we're going to get back to, under a renewed agreement, a renewed approach. We're going to get back to working together on common problems rather than fighting in between ourselves while this common problem only gets bigger.
Speaking of those tariffs, last month, Trump expanded the steel tariffs to include previously exempt derivatives, such as like steel coils. So with these even new additional measures in place, how much more challenging is it to move Canadian steel across the border now?
Yeah, so what those so-called derivative tariffs are doing is they're targeting our Canadian customers. So we sell to, for example, a tractor producer, and then the tractor goes into the United States, where before that might not have been tariffed. Now the derivative tariffs are capturing our Canadian customer base. What this has done essentially is created more urgency to get this 232 regime down. Not only do we have the direct 50% tariff on our own products going into the United States directly, but our Canadian customer base is being devastated by these tariffs as well. So, that's one of the specific areas that we hope to engage with the federal government to do more work to expand the existing work that they have done for us, which we are grateful for, but to expand those border measures to support more of our customer base as well. They're under the exact same situation that we're facing.
Are you optimistic that the federal government will work with you on that?
Even if they are, the one thing that's been the case from the get-go in this trade war is we cannot make up in our domestic market all that we have lost with our U.S. market access being closed. So, I'm optimistic. I've seen, a step-by-step approach by the federal government that has really helped us. So I'm optimistic they will be open to doing more as the urgency of this thing accelerates. At the same time, though, I'm pessimistic in the sense that we're not going to completely be able to offset those losses. There's still quite a gap. And so it points us to the point I was trying to make at the top, which is that we must seek resolution of these 232 tariffs between our two nations. That's simply a priority.
You mentioned dumping in your notes as well. What is the current volume of steel products from China entering Canada, and how does this affect local producers here?
Yeah, well, actually, the Canadian government has taken strong action on China tariffs. And despite, the recent developments between Canada and China, all of those Chinese tariffs have stayed firmly intact. And they've also expanded. So now it's not just steel coming from China, but directly, but also indirectly that is being tariffed. So we have multiple layers of protection against steel dumping from China. That's not to say they're not still here. Our shipment volumes have dropped by about 40% from China into Canada. We'd like to see that drop much further. And of course, we're still taking many trade cases against China. But, what I can say is that the trends are heading in the right direction with respect to, getting non-market economy, unfairly traded steel out of our market.
Okay, is Canada's steel industry currently equipped, do you think, to compete with China in the international market, like for Europe, for example?
Yeah, well, because of this phenomenon I was describing of overcapacity, we have very limited options in terms of diversification outside of North America. That's been one of the unique features of the steel industry, is that we can't really just pivot to somewhere else. So we're really in a circumstance where we either have to, we have to develop our domestic market. That's where those border measures come into place. And then ultimately we have to see a return to, market access to the United States to kind of keep us level and whole.
Just lastly, very quickly, I want to bring Mexico into this too. Like, how can Canada strengthen steel trade collaboration with Mexico?
Yeah, that's one of the benefits of the CUSMA arrangement. Actually, the steel features of CUSMA have been very good to the North American industry as a whole, and create opportunity for more steel trade between Mexico and Canada. So, when we've had, when we both had access to the U.S. market, that didn't take. There was some trade, but not as much trade. And now we're starting to see growth in our trade flows between Mexico and Canada. Okay. It's early days, but that's very encouraging.
That was Catherine Cobden, President and CEO of the Canadian Steel Producers Association. Coming up, we will bring you your latest headlines and we'll update you on the markets. You're watching BNN Bloomberg. Prime Minister Mark Carney and Alberta Premier Danielle Smith will meet today in Calgary, where they're expected to reveal a plan for Alberta to raise its emission price to $130 per ton by 2040. Now, this move comes after Alberta froze its industrial carbon emission price at $95 last year. This move also works to fulfill a pledge between Alberta and Ottawa in November that included a carbon price plan in order to build a pipeline to the West Coast. Shares of Interfor are taking a hit today. That's after sales in the latest quarter fell short of expectations, with revenue falling 13%. Weaker lumber markets are continuing to pressure the forestry sector. The Vancouver-based lumber producer says they expect continued volatility in North American lumber markets as the economy continues to adjust to shifting policies, tariffs, and geopolitical uncertainty. And Applied Materials has raised its sales and profit outlook as surging demand for AI infrastructure continues to drive semiconductor spending higher. The company forecasts third quarter revenue well above analyst expectations, pointing to booming demand for AI computing systems and memory chips used in data centers. And we're watching North American markets today. Stocks are falling amid inflation jitters with a sell-off in global bonds. The TSX is down more than a full percentage point. S&P 500 right now down 0.8%. And the NASDAQ down more than a full percentage point as well. Seems as though investors feeling a little cautious this morning. We're also watching the price of oil. It is now heading for a weekly gain, with Iran war negotiations at an impasse as U.S. President Donald Trump is heading back from Beijing today. It sounds as though him and Xi Jinping appear to be on the same side when it comes to perspective on this war, but nothing really progressing there. Oil up almost 3% at the moment. Gold, we're watching the price of gold as well. It is down again, giving back some of its recent gains. It's down 2.6% today, continuing to watch that. And also copper, which is seeing a sharp sell-off. And we're watching the loonie. It's falling today as the U.S. dollar is gaining on risk sentiment related to the war in Iran. The Canadian dollar down right now, 0.2%. Coming up next is Hot Picks. We will zero in on 3 pharma stocks for your portfolio when we come back. Stay with us. It's time now for Hot Picks, and today we are zeroing in on 3 plays in the pharmaceutical sector. For more, let's welcome Evan Siegerman, Managing Director and Head of Healthcare Research at BMO. It's great to have you join us. Good morning.
Thank you for having me. Good morning to you.
Before we get into your picks, I want to talk about the sector as a whole. Like, how would you describe investor sentiment around the pharma sector right now?
Great question. So we just finished first quarter earnings, and actually they were pretty good print across the board. I think sentiment ending last year was good. Beginning of the year, a little kind of wishy-washy, especially with some of the macro concerns. But leaving 1Q earnings, people are feeling good about the sector. Yes, there are still some, areas where some of these pharma companies need to work on. But I think there's renewed enthusiasm around the GLP-1 space, which we'll talk about with Lilly. Interest into the cancer meeting coming up in early June. And I think folks are, feeling better about things with regard to, say, the FDA now that Makary and Vinay Prasad, who are kind of controversial, are out of their roles.
Do you think the sector is still in kind of an innovation-led cycle?
I think so, for sure. We've seen a lot of M&A, so big biopharma scooping up the small, innovative biotech companies. And that's really a sign of a healthy innovation cycle where the small biotech companies doing the cutting edge science, generating clinical data that interests the big guys take them over and then bring them through to commercialization. So we're seeing that nice bit of M&A, which means we have some health in the sector.
Okay, so let's get into it then. You teased the first one already. Eli Lilly, you say back like they never left. Why is that?
Well, so heading into 1Q results, there was a lot of nervousness around guidance, around kind of the competitive dynamics with Novo Nordisk. And we were really looking to see what their oral GLP-1 pill, Foundayo, was going to do. I think that they put a lot of those concerns to bed. And what's really interesting today, we looked at script numbers for Foundayo versus the Wegovy pill. The Wegovy pill declined slightly, whereas we saw really nice growth for Foundayo. So we expect that to continue. When we look at Lilly, they don't just have an obesity metabolic franchise. They have neuroscience, oncology, immunology. And I think that over the course of the year, we're going to get more data for a key drug called retatrutide. A lot of folks are really interested in that. It could be an even better weight loss drug than, say, Zepbound. And of course, we'll see the pull through from Foundayo as they lean into DTC advertising to kind of drum up some interest with that asset.
You say it's important right now to remember not to over-index on. Right. Tell us more about that.
So, I think a lot of folks are really looking at the script numbers every week for Foundayo and the Wegovy pill, trying to figure out long-term trends. And Lilly only launched Foundayo or Orforglipron in early April. It's mid-May. You can't really make long-term trends and predictions based off of, let's say, 6 weeks worth of data. I am encouraged with what I see. So I don't want folks to say, oh, Nova's the winner, Lilly's the loser, or vice versa. You have to take it week by week, see what happens, and really look at the whole picture versus just one asset.
Okay, we'll move on to the next one now. Gilead Sciences,
Sure.
You've got an outperform rating on this one. Why is that?
Most definitely. So what's really interesting with Gilead is over the past 5 years, which was really remarkable, they have taken a lot of unnecessary OpEx out of their P&L. So now they are in a position where they can grow earnings while they invest in the business. For a long time, this company had been a laggard when it came to the multiple, right? They would always trade at a single-digit multiple, could never really get out of this value trap status. And now they've cleaned up the P&L. They are executing well with their long-acting prevention drug, Yeztugo. They've done some interesting acquisitions, and we're seeing consistent earnings growth, which allows for, multiple expansion. Folks are really comfortable with the story. We know that they have good revenue visibility into the 2030s, and now that they can invest, they can add more franchises to their already strong HIV business.
Okay, last up is Scholar Rock.
Sure.
Tell us more about this company.
So a little mid-cap biotech. What's really interesting about this is they have a drug for muscle wasting, but it's associated with a rare disease called SMA. Well characterized. Biogen has a drug for it. So we know where these patients are. The big controversy has been them getting this drug approved, not because it doesn't work, but because they've had issues with manufacturing, actually related to a facility owned by Catalent, now Novo Nordisk. So the TLDR with that is they are likely to get approved by September. They have a second manufacturing facility up and running and waiting for inspection by the FDA. Once that gets approved, I think people will breathe a sigh of relief. They're also well capitalized, so we're not worried about dilution near term. And I think this could fit nicely within any big biopharma that either has an obesity or rare disease franchise, and there's many of those.
Just lastly, like you mentioned, the sector
Sure.
does have some areas to work on still. What's the main one, do you think?
A great question. I think that a lot of some of the larger names like a Merck, like a Bristol, and even an AbbVie, they still need to do some more BD to add to their pipeline. When you look at Merck, for example, we have a huge loss of exclusivity event at some time, in the late 20s, early 2030s, with Keytruda going off patent. So they're going to have to come up with $20 billion in new revenue. That's not easy to do. You got to do it with acquisitions, internal development. They're well on their way. They're not there yet, similarly with Bristol. And, you even look at AbbVie or Pfizer, right? These companies need to come up with, cohesive revenue stories end of the decade into the 2030s for folks to continue their comfort and continue investing for the long term.
Okay, so interesting. We'll have to leave it there. Evan Seigerman, Managing Director and Head of Healthcare Research at BMO. Appreciate your time today. Thanks so much.
Thank you.
Coming up, we will hear from the CEO of OpenAI on how the record amount of cash they've raised is needed so that the company will have the power to compute all of its AI needs. More on that next. OpenAI CFO Sarah Frier says the ChatGPT maker may raise more capital even after completing what she described as the largest private fundraising round ever. Earlier, we got perspective from her in a Bloomberg interview, and she began by explaining how a large part of her focus is acquiring enough computational resources for its AI systems to perform tasks. That's a term also known as compute. Take a listen.
We believe compute is a huge competitive advantage. We're going up a vertical wall of demand, as we've talked about, even just in the last 6 weeks, seeing the uptick of 5.5, our newest model, 5.5 Cyber. So everyone wants to talk to us about that model in particular. And then on the codec side, we're seeing just incredible lift, over 4 million users now on codecs. That's up, I think it went from 3 million to 4 million in just 2 weeks. And so we need compute, and there's not a lot of compute in 2026. So we are looking out into future years and saying, what can we do to get that compute today?
How do you afford that compute?
So mostly our business model. So we have seen an incredible lift in our revenues to match just the demand that I'm talking about. On top of that, we have raised a lot of money, as you know, from an equity standpoint.
More than $120 billion. I mean, could you need more, though?
It will depend somewhat on matching the demand that we're seeing, the revenue that we'll create, and hence the cash flows, and then that gap to wanting to buy compute out into future years. So I'm not averse to raising more capital, although right now that $122 billion gives us a lot of optionality, and I think de-risks a lot of what we need to go do in the market at the moment.
So dare I ask, would you raise it in the private markets? We've just had reports that Anthropic is looking at slightly bigger valuation than yours at $900 billion and going out and raising $30 billion at least. Would you go to the private markets, or would it be a public?
The private markets have been incredibly generous to us, much bigger to tap than I think most people ever thought possible. I mean, $122 billion is literally the largest private fundraise ever. But there is something attractive about the public markets over time, too, because it's not just about equity, right? We want to be able to, over the long run, raise money across the whole spectrum. And the public markets are significantly bigger than the private markets. So my job as a good CFO is always to create optionality. But first and foremost is we need to keep meeting our customers where they are, and they have a voracious demand right now for our technology.
Talk about that demand, because there had been reports that you hadn't met some of your highest aspirations, stretch goals that you'd set yourselves in terms of how many people are coming to the platform and how customers are using it. Are you meeting them now? Have you got 1 billion people on the platform? How are you looking at it?
So still giving out our number of 900 million plus weekly active users using ChatGPT. Our mission is AGI for the benefit of humanity, and our goal is always to get out into the hands of people and get them using it. So we're delighted with how the consumer platform is going. Images too, so our most recent image model is the best in the world, and it's a ton of fun if you haven't tried it. And that's really caused a very nice uptick on the consumer side. In fact, one of the things we see is that as people come to use something like images, it becomes a really strong acquisition channel for us. And then on the enterprise side, I am, as we talked about, just back to back with customer meetings, and I'm the CFO. So our sales team is just run ragged at the moment. Everyone wants to talk to us about what can I do to transform my business? How can I use the intelligence of the models that's available to me today? And so we just see our business going from strength to strength right now.
From strength to strength, from a consumer perspective, you need the right partners in place. Now, there was an interesting article put out by Mark Gurman today saying that maybe that partnership with Apple is slightly fraying because you're not getting the sort of treatment, or at least the user case that you had expected. Maybe even you bring some legal work towards Apple within that partnership. Is that true? How is that relationship going? Would you think about bringing legal action?
So I'll go back to that mission statement. So AGI for the benefit of humanity. Our goal is to find great partners that have really large distribution to get it into the hands of consumers. So when I look at, we have partners like Kakao in South Korea. PhonePe has actually been an incredible partner in India. And so we know that there is a route to market via these partners, and it can be wildly successful. And we're just going to keep pushing on that.
You are dodging that question. So but is the relationship strong with Apple?
I mean, right now, in terms of our relationship with Apple, it's like every other large distribution partner for consumers. We want to make it work, and we know that consumers want our technology, so we think that there's a way.
You think that there's a way without or with legal action, do you think?
I cannot comment on legal action.
Can you talk to us a little bit about access to compute and how that is an edge versus competition in the market? There's been thoughts that Mythos has perhaps been allowed with certain partnerships maybe because the power of the model, or then others say maybe it's because of a lack of compute. How are you thinking about rolling out your cyber offerings, and whether it's an access to compute issue or whether it's just the power of these models just being so sophisticated?
So 5.5 Cyber in particular is right on par with Mythos. If you look at the UK ASIC group is one of a very good third-party research team. And we're really proud, actually, of the 5.5 Cyber model in particular. In particular, what I love about it, though, is that it is a very efficient model. So it is much cheaper for customers to be able to use it. And in keeping with this point about access, we have gone much broader in letting people have more access to it. The European Union, in fact, just made a comment earlier in the week to give us some kudos on that rollout.
That doesn't happen much.
It does not happen very frequently, but it goes back to, you know, again, very mission aligned for us to make sure that we're putting our technology and democratizing it into the hands of everyone. Now, in something like cyber, we tend to be a little bit more careful because there's a lot of safety and security elements there. This is a model that really can find vulnerabilities in software code at a level that people have not seen before. And so it's also causing huge demand. I think I've been spending a bunch of time with banks and financial institutions. I have not talked to a single CEO of a bank that does not have this as their top priority currently.
In terms of, therefore, priorities going forward, with the safety of what's being deployed, but also the need for energy and for scale, what is the key bottleneck, do you think, for just getting this into as many people's hands as possible?
Yeah, so there's really three big components to a model. It's the compute itself, it's data, and it's great researchers. The biggest compute is always the people, so great researchers I'll always come back to. There's just not that many of them in the world.
I've heard they're quite expensive too.
We are super proud of the team at OpenAI. I think one of the things, it's about the cost to hire them, but more than that, that they can get access to compute to do the research that really inspires them. On top of that, compute itself has clearly been a bottleneck. I don't think any of us, even Sam and Greg, who I think were incredibly prescient overall in terms of the need for compute, I don't think they could have foreseen just the sheer demand that we have right now in 2026. And so it's the energy that sits behind it. We're seeing memory out of Southeast Asia, right? There's all of these choke points in the supply chain, and this is why it behooves us to get ahead of that, strike those partnerships earlier when people are maybe not seeing just the sheer scale.
Let's talk about partnership and about some of the people you just talked about, Greg Brockman and Sam Altman. They've had a tough week in terms of being in trial, having their relationships sort of cast into the limelight. What is it like working with Sam? There's been some questioning as to how you work alongside him. Do you work well? Is it a strong bond? Is he trustworthy? As it seemed to have been grilled by certain lawyers of Elon Musk this week.
So I think Mr. Musk is very much out to just distract, and we are just staying the course, like building our technology, putting it into customers' hands, and really creating AGI for the benefit of humanity. Working with Sam is great. We get on incredibly well. I think we have a wonderful partnership, super good yin and yang. Sam pushes, he's super curious. My job is to take that curiosity and create optionality. So just as we talked about, whether it's making sure we have enough compute, making sure we have the funds to do it, making sure we build the business strongly. And I spend an inordinate amount of time with customers, as does Sam, and we get to compare a lot of notes on that front, as well as sometimes our notes on parenting. So it goes the whole gamut, frankly.
Okay, we're going to take a quick check on the markets before we wrap things up here. It's been an interesting day so far, and really trading has only begun about an hour and a half ago. You can see in North American equities, all trading down at the moment. It seems as though there's some inflation jitters out there after some bond yields have been sold off, and we're seeing U.S. stocks in particular down, NASDAQ down more than a full percentage point, and the TSX as well, down 1.3% at the moment. So all in the red. We'll continue to watch that for you today. That wraps up this edition of The Open. Stay with us, though. Morning Markets with Roger Peterson are next.